Perfect, perfect. I want you to bring this home for us, if you can. Share, maybe some examples that you've had in the past, as far as with more in the bridge loans that you guys offer. Do you have any examples as far as the program? As far as that you can really enlighten us on real life examples that you guys have had, so that we can really just kind of understand a little bit more in detail the program and the program benefits.
Yeah, absolutely. So first off, if anybody chooses to go to our website, it's more, M-O-R-E, sellerfinancing.com. And if you click on, there's a listing button. I'm going to go ahead and pull that up real quick. Let me share that screen here. Parker, let me know if you can see that.
Absolutely, we're live. I can see it.
Okay, excellent. So these are, if you're a buyer, investor, you want to expand your portfolio with your firm, and how would it look like if you could actually pick up properties with these interest rates? I mean, so you get pre-approved on a DSCR loan, and we're able to go in and negotiate here a 5.125% interest rate for you on a $450,000 condo. These are actually primary residence rates we were quoting. This buyer would say $465 per month. Let me scroll down to one, because here's one that I can that we just recently closed. This was a $450,000 condo as well here in Austin, Texas. And this buyer in particular was requiring 20% down. So if the buyer put 90,000 down, this buyer would have been saving $525 a month from a primary residence interest rate at 7.25% at the time that this property closed. And so on an investment property, since our audience generally is investors, if this were 7.75, this is going to be closer to $600 a month monthly savings, giving this property a huge opportunity to cash flow. You can see the principal interest payment is significantly lower. It's below $2,000 a month here. So if we utilize, you can just go to our listing screen. You can see all the ones that are sold. Again, these are mostly in Austin, as we are just now starting to roll out across the country and onboard that. But what I can do is even show one of these calculators. And let me see here. That one in particular, this is kind of what it would look like from a seller side. Let me get that share screen down. Sorry about this. Here we go.
I love it. This is good information.
Yeah, no, thank you. So really what we really always like to show, what is it from a seller's perspective? What are you looking for? You just want to get a higher sales price and sell it generally faster, right? So you want to get this program allows for better marketing, increased buyer traffic, maximizing the sales price, because if you're getting a below private wealth interest rate that the seller's offering, usually sales price, the seller's expectation is that they're not going to get beat up anymore on sales price. Most sellers have already come down to usually once or twice or reductions in their sales prices. Other huge benefit, though, is the interest income. Remember, we talked about that arbitrage income, Marco, and then a turnkey solution. So we are the first people that have come out and said, this is how a seller financing bridge loan works in the entire country. We're the first company that's come out. Then we handle all the education to the seller, all the education to the listing agent, all the co-marketing that goes in MLS, all of the education to the buyer, all the education to the buyer's agent. Who services the loan? We have our own servicing company that we have. We have our own law firm and title companies to make sure it's all legal, compliant, enforceable, and has protections for both the buyer and seller from predatory lending, and to make sure that there's always an exit plan and an exit strategy in place, and reducing the risk for the transaction overall. So that's what we come in and do there. And then from a buyer's perspective, what do they want? They're getting far below market interest rates, particularly for investors, since that's generally our audience on this one call. They're getting rates really on almost 3 points below the market. There's significantly reduced closing costs. None of these are programmed. While it does have a 1 point of the sales price fee, It's generally far below the total cost that they would pay for a traditional loan. And then they can move up or upgrade opportunities. So the recap on that program, that home that I just showed you, in this case, that seller was leaving a little bit of money on the table. So what this looks like, they had, if the seller were to sell traditionally, they would have walked away with about $65,000 after all closing costs, realtor fees, the whole 9 yards. With our program, taking the $90,000 down, paying all the agents, they walked away with a little bit less. So they actually only left $11,000, and that was a real life closed transaction. They only left $11,000 on the table, but they were actually making monthly arbitrage earnings of $21,000. Let me see here. Overview. That seller in particular had a 2.75% interest rate. This and let me see here. Hold on one moment. Cash flow. Here we go. That buyer ended up not having the best credit. So we were marketing the property at 4.99. We helped the seller adjust that interest rate up because the buyer did not have the best credit. But it was far below. The buyer ended up getting pre-approved at 7.75% with us. And then the seller had a 2.75% interest rate. So the seller, every month after they sold the home, that means the home is deeded to the buyer. If Scott's our buyer, Scott got deeded the home. After you sold the home, Marco, you're still making $594 a month. You got your down payment plus $594 a month. Then when the buyer refinances, in this case, it was 36 months, you as the seller are going to get the final equity that's in the property of $43,000. Now, if you remember, when I went through this, you only left about $11,000 of total equity on the table. But how come you're getting $43,000? Well, you currently still have that loan in place. Remember, at 2.75%.
Mm-hmm.
That's in the case Scott is the purchaser and he's paying down your mortgage. Well, guess what? Scott, you're the bank, Marco. We taught you how to do our bridge loan. You did our bridge loan program. And that means Scott paid down and built additional equity by paying down your current mortgage to the tune over 3 years of $32,000 more. When you bring all of that together, this is what it looks like. And instead of you making, when you add the $21,400, that's you making that monthly arbitrage of the $594 a month, I think it was, times 36, plus the $43,000, which is the 11 grand, 65 minus 54, that's $11,000 roughly, plus that 30, what was it, the 37, I think it was, that equals a total of 43, 32, 43, 80, 88, 60, sorry. Giving the seller, over just a 3-year period of time, you made 45% more profit on this home. 45% more profit by getting paid out over 3 years. And all you left on the table was 11 grand. So my question to you, Marco, if you were doing this presentation, would you trade, leave 11 grand in the deal in order to make $54,000?
Absolutely.
Yeah. And guess what? There's also a nice cherry on top. In the event that the buyer, in this case, Scott, stops making his payments, you get to foreclose. And our law firm is built into all of our entire transactions. They're paid for up front as part of the transaction closing costs. They will step in and handle that foreclosure and eviction process on your behalf. You don't ever have to get involved. Our mortgage servicing company handles all the payments, all the escrow. All of the buyers are required to escrow. So there's no tax and insurance risk. There's no risk that Scott makes the payment to you and you don't make the mortgage payment, because our mortgage servicing company is required to handle all the payments. And then they send you the arbitrage, in this case, that $594 a month. So yeah, you made 5 times your money by leaving 11 grand in.
So this is perfect.